Hello from Bloomington. I'm Heidi Kessner, Dean of the Kelley School of Business. I want to thank you for participating in this important roundtable discussion. Wherever you are in the world, the pandemic has been and continues to be challenging on many levels. Many are experiencing stress and heartache from losing family and friends. In addition, the pandemic has disrupted our everyday lives and livelihoods on a global scale. And of course, there are ample uncertainties going forward. I think we can all agree we still have very challenging paths to navigate, paths that require short-term and long-term solutions. As we look forward to recovery, it's imperative that we share ideas, insights, and best practices so we can lift each other up and press ahead on solid footing. We'll have to be nimble as well, opening ourselves up to new ideas and visions wherever they may take us. The pandemic has certainly shown us just how interconnected we are. We are truly all in this together, and we will recover together. I urge you to keep the conversation going long after this roundtable program ends. Thank you again for participating, and please stay healthy and safe.
Welcome to the Indiana University Kelley School of Business's Worldwide Roundtable Discussion. My name is Levon Schlegel, and I'm the Executive Director of the Institute for International Business, or IIB, as we are more fondly known. I would like to thank Dean Kessner for kicking off our second set of roundtables in our 10th anniversary celebration series. Thank you all for joining us as we begin the fifth and final panel discussion. During these last 2 days, we've heard from distinguished speakers in Sub-Saharan Africa, Mexico and Latin America, the Middle East, North Africa, China, and finally, here, the United States. We've all gathered to tackle a topic that's on everyone's mind, the economic recovery post-pandemic. As you can imagine, it has taken a global team to put together these 5 events. I would like to thank Jen Goyens and Allison DeWitt from the Kelley Schools Alumni Association, Roy Hooper from the IU Alumni Association, Ali Batten, Director of the IU Global Gateways, Rebecca Salerno, Kelley Marketing, Zach Watt and Brian Boucher from the Kelley Learning Media team. And finally, I'd like to thank Tim Smith from IIB, without whom this project would not have happened. You will meet Tim at the end of the program as he moderates any questions that you might have during the event. Just a note, please use the Q&A function to share your questions and feel free to do so throughout the conversation. The last year has been unprecedented in our lifetime. The COVID-19 virus has forced us all to redefine how we work, how we communicate, and even how we buy groceries. Individually, our worlds have gotten so much smaller, and with that, our purchasing behaviors have changed dramatically. From hoarding essential items to not participating in our local economies, our relationship with the broader economy has changed regardless of where you are in the world. Unemployment is high, supply chains are challenged, transportation and logistics have had to redefine the way they deliver products and services. We have asked our panel to explore what this means. How do we kickstart our local, our regional, and our world economies to return to some level of normal? And in parallel to regenerating what we had, we need to ask, what did we learn so we're prepared for the next time? And maybe most importantly, what are the good ideas that emerged from this massive macro disruption that need to be continued? Not a small topic, but that said, our moderator and panel for the day are more than up to the task. It is my pleasure to introduce today's moderator, Phil Powell. Phil serves as Associate Dean of Academic Programs at the Indiana University Kelley School of Business, managing the Kelley School's portfolio of graduate and undergraduate programs delivered from the IUPUI campus in Indianapolis. He also oversees projects for the Kelley School that drive innovation, outreach, economic development, and fundraising. While at Kelley, he has chaired both the Bloomington MBA program and Kelley Direct, our leading online MBA program. Dean Powell is the Daniel C. Smith Faculty Fellow and has been with the Kelley School since 1996 as a business economics faculty member. With a PhD in economics from Vanderbilt University, his published research focuses upon business and economic development and emerging markets. On a personal note, Phil has been an amazing supporter of IIB through the years, and I'm very honored to be able to call him a friend and a colleague. So Phil, welcome and thank you for moderating today's distinguished panel.
Absolutely, Levon. Thank you. And thank everybody for your gift of time today with us, where we talk about a topic I know that's in all of our minds, and that is, what does the U.S. economy have in store for the rest of 2021? We're closing the first quarter here, so we're just about to enter the second quarter. And I think it's going to be a wild ride, and you're going to get that impression from our discussion today with our panel. Also, we've seen huge changes in our economic landscape, both in terms of what we face in the United States, but also globally and how the U.S. fits into that new landscape. So we're going to take the time. We've got the space today to really explore those and talk about how this is affecting, especially corporate America, in terms of all these changes, and how we want you to walk away from today with some practical insights of where we're headed and how to manage it, how to grapple with it, how to navigate it as a manager or an executive. So without further ado, I'd love to introduce our esteemed panel members, and I'll kick it off with a question about where we're headed with the economy. Well, we have three very accomplished members of the Kelley School family who are giving us their gift of time to join us and give us their insights. Our first panel member is Barbara McKenzie. Barbara is Senior Executive Director of Investments for Principal Global Investors, which is the asset management arm of the Principal Financial Group. She is responsible for several investment boutiques, managing approximately $165 billion. It's a lot of zeros. $165 billion, and has strategic responsibility for Principal's collective investment trust platform in the United States. In addition, she oversees compliance globally for the firm and serves as a director for businesses in the United States, Brazil, Japan, Australia, Hong Kong, and Singapore. She joined the firm in 1984 in their private markets commercial real estate team, after which she led the firm's fixed income portfolio management team, served as international sales and business head, managed numerous funds platforms globally, and headed operations and technology for the firm, among other responsibilities. She earned her MBA from the Kelley School of Business in finance. And as you can see, she has depth of experience in being able to connect what's going on here with the rest of the world. Barb, it's absolutely an honor to have you on the panel today.
Thanks, Phil.
Look forward to your insights. Our next panel member is Eli Kumar. Eli is a global finance executive with extensive experience across industries, gained through a variety of key financial and strategic leadership roles at global Fortune 100 companies. So his breadth, Eli, just an impressive breadth of experience here. I know you currently are vice president and global CFO at Jordan Brand and vice president of finance at Global Nike Women's at Nike. I know you guys have had an interesting story in the news here recently, which I know is giving you press that you may not want. So hopefully you're not having to deal with that. That's not too much of a distraction for you. In Eli, in his role in the women's division at Nike, in the global women's division, he has dual accountability for financial and operational performance, the full P&L, and also corporate strategy for the global Jordan Brand, as well as financial and strategic management of global Nike women's franchise. A very broad portfolio that we know keeps you busy, Eli. Prior to his tenure at Nike, he spent over 11 years in the pharmaceutical industry in roles of increasing responsibility and complexity, most recently with AstraZeneca, where he held multi-billion-dollar CFO roles, leading large, complex businesses. Eli's career has also included periods at Novartis, Deloitte Consulting, Hewlett-Packard or HP, Cigna Healthcare, and Reliant Energy. Eli's an absolutely dynamic leader, holds a MBA in finance from the Kelley School of Business, the most important part of the bio here. But he's also a Longhorn. He has a Bachelor of Arts in Economics from the University of Texas at Austin, and has completed executive education programs at Wharton, Booth School at the University of Chicago. And he's also a veteran of the U.S. Armed Forces. Eli, thanks for being here and thanks for your service. And what an impressive record.
Thank you.
Look forward to your insights, especially from the corporate perspective. Our last guest of the panel is a fellow economist, Michael Gapin. Michael is Managing Director and Head of U.S. Economics Research at Barclays and is responsible for the firm's outlook for the U.S. economy, and in particular, U.S. monetary policy and the impact of financial markets on the economy. So Michael will give us some good insight on what to do with our retirement portfolios. Prior to taking this role, Michael was a senior U.S. economist, and following his appointment as asset allocation strategist in January 2012, he took on additional responsibility for forming the firm's asset allocation views and marketing them to clients. Michael joined Barclays in 2010 from the Board of Governors at the Federal Reserve. So he's been both on the investment side of policy and on the Fed side. At the Fed, he was section chief responsible for monetary and financial market analysis. In that capacity, he assisted the board and the FMOC, the Fed Open Markets Committee, in the formulation of monetary policy and the Federal Reserve's response to the financial crisis. What an exciting time to be at the Fed. Prior to that, he served as an economist with the International Monetary Fund. Michael also has taught finance and economics at institutions, including the great Kelley School of Business, our sister Department of Economics across campus there in Bloomington. He's also taught at the Mendoza College of Business at Notre Dame and the Department of Economics at Johns Hopkins. He holds a PhD from the Department of Economics at Indiana University and brings this phenomenal mix of perspective from academia, the Fed, and the private investment sector. Michael, welcome.
Thank you.
So with that, let's jump into our discussion. I think, at least as we look at the United States, there's no question that an economic recovery is underway. In fact, if you look at the data, even parts of the second quarter last year saw the beginning of this recovery. And I think everybody's hopes are high for the rest of the year. And as I'm watching forecasts, everybody keeps adjusting up their forecasts. So we know recovery is underway. The question is, what's this experience going to be like? What's this ride going to be like? Is it going to be a nice, smooth ride upward? Or is it going to be a bumpy ride up, both in terms of new paradigms in the economy and also the risks that come with us, especially, how long are the vaccines going to last? Is there going to be another spike? Are we going to see certain bubbles burst in the economy? So here's a question I want to put on the table. And Michael, we'll start with you on this. But we know a U.S. recovery is underway. But what are the surprises we should expect? How do you think this recovery is going to differ from past recoveries, both in terms of the next couple of months, next several months, and into the next few years? And even more importantly, what new vulnerabilities should businesses anticipate in spite of what's going to be a great rebound? Michael, what do you think?
Thank you for that question, and hello, everyone. I think certainly in the near term, we're in for, I think, a very strong rebound. Near term, I'm meaning 4 to 6 quarters horizon. I do think things are going to be quite strong. I think what is different this time is in a normal downturn, households stop buying durables, right? We don't buy autos, we don't buy appliances. So services consumption stays basically flat, but we pull back on big ticket items. And we tend to have jobless recoveries. At least the last 2 times around, recoveries in the labor market have lagged the broader rebound in activity, in part because the goods sector is very productive in the US. And so we stop buying goods and then we slowly start to buy them, and the rebound in employment is slower. So the last 2 recoveries, from the tech bubble and the 08 bust, have been generally considered jobless recoveries. This time, I think the narrative is flipped, right? We're all buying goods. The consumption of goods is well above where we were pre-pandemic. what we've cut back on is face-to-face services. And so I think that with the pace of vaccines being quite strong, at least vaccinating over 2.5 million doses a day, or 1.25 million full vaccinations on average per day, we think it will lead to a fairly steady opening up of the supply side of the economy, meaning more face-to-face services. And so it's the reverse. It's services that's going to rebound. And we think that means employment will also rebound, because services generally are lower productivity sectors. If you want to increase output, you have to do it by increasing employment. So I think this will be more V-shaped, and will come with a lot more job growth. For example, I think we'll see a very, very strong employment forecast on Friday. We're looking for almost 1 million on Friday. We have about 6.5 million jobs coming back from current levels over the remainder of the year. So I think it'll be more V-shaped. It'll be more coming with a lot more employment. So there's a potential for, say, follow through in terms of activity. You employ more people, they get more income, they're able to consume. What I think, just on touching on a few of your other points, what I think has been most surprising, obviously the pandemic itself is a big surprise, but what's been most surprising is the sheer magnitude of fiscal policy response put into play. So I do think there's a bit of a paradigm shift here in terms of how fiscal policy may be responding to downturns in the future, and just the sheer amount of resources that we're putting in as emergency stabilization is important. We estimate there's about almost 2 trillion in what we would call excess savings sitting on household balance sheets. Some of that is because of the high number of fiscal transfers that have been used. I think what's the uncertainty question that you mentioned, I think has to do with, like you said, do we solve the pandemic in a medical sense? Do we extinguish COVID, for example? Or are we solving the pandemic in what I'll call an economic sense, where vaccines and variants have an ongoing fight? So COVID doesn't go away, but maybe we diminish its severity such that we don't have hospitalizations and deaths, but we kind of have ongoing vaccination programs and still kind of this back and forth in case counts versus activity. So I think there's still a lot of uncertainty about how COVID plays out and how quickly services activity come back. But that's would be my answer in terms of what's different now versus prior recoveries. What's been surprising and what lingering uncertainties we may have to face.
Thanks, Michael. Now let's take it into the corporate sector. Eli, I'm curious, as you sit at Nike, as you sit with the Jordan brands, what's your perspective on these questions of where the economy's headed in the short run, and what are some new paradigms? And even though business might be booming, because if you've got houses sitting on excess savings, that's pent up demand. And I'm sure some of that would translate to some great sales for some great shoes and other sports products. But I'm especially interested in what do you see as challenges that could actually, cause some pain, or some derailment on things that where you wouldn't expect it.
Yeah, look, I think Michael summarized it, a lot of the key macro factors, obviously, and I think he was spot on with a lot of what he said. Taking my employers out of it, I tend to put myself in the shoes of, what any, sort of corporate executive, would think about as you anticipate. And I think one, regardless of where you sit and what business you're in and what sector and your exposure, you're really thinking about who your consumers are and how they're going to sort of show up, right? We saw in over the last year or so, the migration of consumers to digital, right? And companies that have been able to sort of take advantage of it or weather a bit have been those that had the capabilities or were quickly and rapidly accelerating their digital transformations. I think going forward, that's on the top of everybody's mind is our consumer patterns and consumer behaviors going to prevail as we sort of exit the COVID era, or as things stabilize and the vaccine rollout starts to take hold. Broader retail rebound, right? You saw obviously brick and mortar has seen some challenges over the last year. And again, everything has accelerated the push and the move to digital. And so those are some of the things top of mind to say, will we return to business as normal, or has the shift, is the shift a permanent shift to where you're seeing consumption and new consumption patterns and new consumer buying patterns and spending patterns, because you've almost had years worth of innovation and shifts happen almost over the course of days, months, and overnight. And so, like I said, I think everybody's thinking about how do you serve the consumer, who are your consumers, how do you better know them, how do you serve them in a new world that's going increasingly digital, and then structurally taking a step back, how are your supply chains? We've really seen entire industries, but more specifically companies, being either exposed or being able to capitalize on some of the supply chain shocks we've seen, but also really a push to really glaring deficiencies where we're seeing the need for more sustainable products, more sustainable supply chains, more sustainable ways of thinking about operating models. And so I know I'm unpacking a lot here, but for me, it's more through the lens of ultimately, when you look at your operating model, who your consumer is and how you serve them and how they've shifted their attitudes, and not only around consumption, but how they interact with different businesses. Will that stay? Is that shift permanent? And number two, how do you invest to rapidly catch up in areas where you are deficient or actually start to lead? So, and also the unknown factor, right? To Michael's point, the vaccine rollout is a huge determinant of the recovery, and it's this tiny invisible thing. And also not understanding when the end is in sight, because again, there's going to be a second wave. And from my perspective, just personally, we live in the global economy, right? So it's not just the pace of recovery of our U.S. markets, but it's also the broader international pace of recovery from all countries, right? Across the board. And the longer it takes some of those economies to come back, I think the longer or the more the impacts would be.
Eli, just to follow up, I'm curious, what adjectives would you use to describe the emotions right now in the executive suite? I know there's kind of the rational part of what you need to focus on, but what's the sense, what's the energy like in the executive office as we go into the second quarter?
It's tough. It's in Zoom, emotions sort of are all over the place and it's tough, but I would say mine is cautiously optimistic, right? Just because of, when it comes to emotions, I'll bank on mine, but cautiously optimistic. Look, we see light at the end of the tunnel, at least to your point, is there a lot of positive indicators, but there's also, from my perspective, just recognizing that we have to be tempered a bit. We're not out of the woods yet. And there are a lot of unknowns out there, but from my perspective is cautious optimism. Excellent.
Barb, what about yourself? What are y'all seeing, and just kind of tie into what we've been hearing? Does your perspective kind of fall in, or maybe you're seeing a different perspective than Eli and Michael?
Yeah, well, maybe I'll start by going back to just the basic economy and where we're at. Like Michael, the U.S. is clearly poised for a lot of growth this year, as is China. Those two big economies are definitely on the right track, and hopefully will carry on a global basis this recovery. Interestingly, I'd throw in that the other group is the UK, who's way out front of the rest of Europe around the vaccination quest, and ironically now have something to talk about with their voters in the country about why they went through Brexit, good or bad. Some of the nationalist tendencies, I think, will be very dominant moving forward. And some of the things that have played out in the pandemic, again, like UK, not being constrained by Europe on the vaccination side, will be interesting talking points to watch as we move through the year. The Fed obviously is another place to watch, and they just couldn't be any more clear about saying in a very unprecedented manner almost, we really don't care about inflation. We're really not going to look much at inflation prints over the next year. We're just all about growth and stabilization. And ironically, I think a lot of people don't believe them yet. And it reminds me of myself back in the days after, Lehman went under and the GFC was unfolding, when the Fed said, we're just going to be very religious about making sure we get back to full employment before we raise rates. And I think a lot of people were also skeptical at that time that there would be great patience. And I would suggest there is going to be great patience. And in actual fact, there's almost a necessity when you look at the stimulus that's going out and the ability of governments to afford to pay for it. Governments are going to want to keep rates very, very low for a long time. And then I just throw in, the other thing that we really need to look at and be mindful of this year are emerging markets. Principal has a lot of operations in emerging markets. I spend a great deal of time with my colleagues in those locations. And oh my gosh, it is really bad what's going on with COVID in places like Brazil today. Of the 4 people in my team in Sao Paulo that I interact with, they've lost 3 family members just this quarter. I think the unevenness of the vaccine rollout, the more contagious strains that we're seeing are by far the biggest risk out there that could interrupt and make this recovery much less robust or much less even than we're all thinking right now.
Barb, I want to bring up your point about the Fed. First, I want to circle back on that. But first of all, I sort of wrote down what I kind of gathered from everybody's comments and it goes back to the question I asked earlier. What makes this recovery unique? What makes this a recovery like none that we've seen before? And that the following have kind of come to mind is sort of aggregate what you guys have said. So a job-filled recovery. So the growth in jobs might actually be more than the economy. The risk is not being driven by traditional sort of business cycle risk. It's being driven by public health risk, right? And it's these new variants and how long the vaccine's going to last. How do markets price that in? That's going to be a challenge.
Yes.
We are still trying to fix our supply chains. And of course, the issue with the Suez being blocked for a week didn't help. Right behind that's this issue of nationalism, right? In most global recoveries, everybody's wanting to act and coordinate and celebrate a globalization and the flat Earth hypothesis from the 90s. Now we're starting to see this rise of nationalism as China, this decoupling of China from the United States, and different spheres of influence. That's sort of also gets into the geopolitics of what's going on. That's just kind of a new. I think it's this new reflection of where we are in geopolitics in the 21st century. We have this hyperactive fiscal stimulus. Never before have we seen a $3 trillion infusion when we're this close to full employment. And whereas the United States really doesn't score well on managing the pandemic, we're actually doing really well in terms of the vaccine rollout. So I wanted to capture that in the moment. I want to go back to this question about inflation. So when you look at unemployment rates, they've fallen. We're down below 8%. In Indiana, we're at about 5%. This is what economists would consider close to full employment. We're pouring $3 trillion of stimulus on this. We've got, Michael talked about that there's $2 trillion of excess private savings sitting in people's investments and accounts, or their Bitcoin and their trading baseball trading cards. And then we've got a Federal Reserve that just is like, hey, let's keep the party going. Let's keep these interest rates close to zero. Don't worry about inflation. How do we make sense of this? If I'm reading my economics textbooks, I'm going, are we back in the 70s? With poor performing stock markets and a return to 5, 6, 7, 8, 6% inflation rates. What do you think, Barb?
I don't think we're going back to the 70s anytime soon. I mean, Quite honestly, I've been much more worried about the deflationary Japan scenario for the last many years. And when you think about just what's unfolded in the last year in terms of technology advancements and the permission to make those advancements that many regulators and governments have now permitted, again, the efficiency gains and where we're going, I think, are going to be a dampening effect on employment. I mean, I just look at my own industry, and Michael, I'd be interested in your views on that. In financial services, you know, getting a regulator to say yes to running a trade desk from home is something no one could ever have contemplated until last March. And it just happened overnight, right? So a lot of the things that have been big regulatory impediments, Eli could also talk about it with his AstraZeneca experience, you know, the speed to market of the vaccines. I mean, think about what's played out in the last 12 months and how unprecedented that is. It's a totally new lens that we take in looking ahead at the corporate world and what you can do. It's no longer so much about asking permission to do things. It's more about just pushing ahead and doing it. But I'd be interested in others.
I really like the logic of the counter argument. You know, we know that inflation occurs because people want to spend a lot of money, but the capacity of firms to deliver on the supply side can't keep up. One of the most powerful ways to increase capacity is innovation. And you're making a supply side argument that perhaps another thing that we could add to this list would be that the rate of innovation, the rate of total factor productivity growth, as we say, is going to be higher than we would expect, which was logically always dampens inflation, because inflation is always caused by demand that's growing faster than supply. But if you have a lot of innovation going on, supply can catch up. Eli, I'm curious, what's the discussion on inflation in the executive suite? What are you seeing there? What are your expectations? And when you look at these very accommodative, generous, what I call hyperactive fiscal and monetary policies, and I don't mean that pejorative way, but it's hyperactive. It's a lot of money. Yeah. How's that factored into how y'all see where prices are headed and just general business decision making?
I think it's a great question. Obviously, it's going to be the top of every executive's mind in terms of where you anticipate it going, if you could potentially take any steps to mitigate it. But even broader than the sort of typical, sort of discussions, one of the things you talked about, the economic stimulus and the size of the packages, and actually the probably unprecedented willingness of central banks and governments all over the world to step in and really lend a hand. For me and for others, I'm sure what also is top of mind is the fact that the opportunity gaps have also widened, right? Because while economies are benefiting, we also, I talked a bit about not just emerging economies, but even the US, all sectors of the economy. And the fact that, hey, one thing that this last year, even though the economy is strong, has highlighted also is not only the wealth gap, but the opportunity gap, just due to the dynamics of working from home, Zoom, et cetera, and just making sure as we go forward that all sectors for an economy to be robust are coming along, having the same opportunities and being able to participate. And even as we, again, I don't necessarily know if everybody's super worried about inflation versus the contrary, as Barb mentioned, but making sure that as we think of the future, we are challenging ourselves around things that we thought were norms, right? Barb talked about not just processes, but ways of working, ways of operating in the past that were long drawn out or done for a certain purpose. I think we've gotten comfortable with, hey, for anybody to survive and thrive, you have to really challenge the paradigms, and we're seeing teams do that, and you're seeing the pivot of not just investment dollars, but the focus on the future more aggressively as people realize, hey, the last 12 months taught us all the things we took as sacred in terms of ways of working, ways of operating, ways of going to market, et cetera, have been crashed, are no longer valid. And so I think the focus more is on getting ahead of, hey, how do we take the things we considered sacred, or we take your strategies or your path you anticipated forward and accelerate it and really move that forward. So I know I didn't answer your inflation question specifically, but for me, it's more around, hey, how do we make sure the opportunity gaps, and yes, there's an influx of capital, things are going well. There's a lot of economic activity out there, but also that we are being very cognizant of where there are gaps and how do we try to ensure that those gaps don't become too wide. I think Michael talked a bit about, is this going to be, I think you said an economic recovery or a health recovery? I think that's a huge one, right? Because also, again, this has exposed the disparities from a healthcare perspective, and for the economy to be fully humming and working, we have to figure out how to ensure that some of those things are not exacerbated as a result of working from home or the new ways of working with the new norm. Because we know on the back end of this, right, and maybe it's part of the next question, ways of working from home, Zoom, certain things are going to become part of the equation, might not be the full equation as they are now, but those will also have a potential impact on how things recover in the broader. So I know I didn't directly answer it because I think the economists are better positioned to do that, but I just want to give my thoughts.
Just to kind of pull together, build on the point you're making that I think builds on Barb's. I go back to what you said earlier, cautiously optimistic. And you're reinforcing this sort of optimistic perspective, which I think is very insightful. But also, Barb, you talked about in that, I think a lot of people realize they've got a choice. If you're a manager or an executive, you got a choice. We can go, oh, okay, this pandemic is over. We can try to get back to normal, whatever that means anymore. Or we can realize that minds are much more open than they were ever. You could argue that there's never been an opportunity in recent history to accelerate change because people are more willing to accept the change. What they thought was impossible 13 months ago, they're like, hey, let's try it. Right? All of a sudden, I think, Eli, this gets to your point, then the corporate, if you're sophisticated, if you see what opportunities are, then your mindset in the executive suite should be, wow, we have an unprecedented opportunity to double or triple our speed of investing in innovation. And that would reinforce Barb's point. That'd be the mindset that reinforced Barb's optimistic point that perhaps we can deliver on a much higher productivity growth than what we would expect. And so again, if that comes to fruition, that naturally works against inflation. And we can have what we had in the 90s where, we had really impressive growth in the 90s. We had no inflation because there was that innovation growth. There was that productivity growth because of the advent of the internet and a lot of new technology discoveries coming together. Here it could be the manifestation of this new innovation mindset, which would be a broader new generation platform for innovation. Michael, I'm curious. I still come back to my dismal science training that there's still, that's these trillions and trillions and trillions of dollars. I don't know if I'm buying this argument against inflation. I'm torn. How fearful are you of inflation? Are you buying these arguments from the Fed?
It doesn't have to be a fully dismal science. Look, I'll make a couple of points. I don't want to repeat too much of what Eli and Barb said. I think they made fantastic points. So just a couple of things. One, these packages are large at the headline. You're right, trillions of dollars. But I would argue aid is different than stimulus. These are basically one-off payments for the most part. Their effect on the economy is much shorter lived. When we look at kind of the spend out on the economy, it's about 80% of it is done in 3 to 4 quarters. It's not like the Tax Cut and Jobs Act, which changed the revenue profile for the federal government for 10 or 20 years, right? So aid is different than stimulus. And we tend to think in economic language, we say it also has smaller multipliers, meaning some of the spending at the federal level is likely just substituting for spending that would have happened somewhere else at the private sector or the state and local level. So it's more substitution. You move the cost to the balance sheet with the most flexibility. So vaccine rollouts, the federal government's paying for it. It's paying for the cost of getting shots into arms. States or you and I would have had to pay for it somehow anyway. So there's a lot of substitution going on here. So take the headline number, cut it at least in half, if not more, in terms of economic effect, and it's going to come in the short term. And I think what Eli and Barb are arguing, in what I would say in economics, we'd say it sounds more like a shift in relative prices than a shock to the price levels. My guess is Nike is dealing with a lot of supply chain price pressures, lags in getting things into the United States. The cost of shipping things has gone up dramatically. Delays in the supply chain are probably an issue. Those should go away. If the pandemic is somewhat resolving itself over time, those constraints should go away. The marginal dollar will be shifting back to services. The supply side, as you mentioned, should get a little bit easier. So I do think that there are reasons to suspect we'll get some inflation, but not a lot. I think to get a lot of inflation, at the end of the day, you'd have to say the Fed will make a policy mistake and just allow it all to happen and never really attempt to course correct. That's not what I hear the Fed saying. I kind of, hear the Fed saying, yeah, so what if we did inflation at 3% for 2 years? So what? If that's what it takes to get everything right-faced, right-oriented, that's fine. They'll accept that. The Fed will not accept 4 to 5 to 6% inflation. So maybe I'm a homer. You're right. You pointed out I used to work there. I think there's a huge gap between saying some inflation is fine to kind of get out of this. But I think you'd have to say the Fed's going to be asleep at the switch for 5 to 7 years and lets all these pressures build unsustainably in order to get 1970 style outcomes. So I'm fairly sanguine on it, as well as I think what I hear Bob and Eli are saying. Sorry, Barb and Eli.
Michael, thank you. And I think that, again, back to your point, Barb, avoiding the deflationary cycle that Japan has been in for a long time is something we want to avoid. So I don't know, Barb, you want to reinforce that point? I think I don't think a lot of our audience would maybe understand the Japan situation, but it is something we need to be as leery of as the 1970s scenario.
Yeah, I mean, Japan is way out there on the technology front, right? Very advanced economy, much older population than a lot of other countries. And again, for a whole host of reasons, they've just struggled for a couple of decades now with deflation. And again, as you look at us, pre-pandemic, that was my major concern, that we were becoming more Japan-like. And again, deflation isn't necessarily an evil, but again, it just kind of feeds back into the psyche. If you have certain economies like China accelerating and advancing at 7-8% growth rates, and developed world is just skimming along, barely positive, it does kind of upset that equilibrium. And the other thing I might take the opportunity to just talk a minute about is supply chains too. I really thought 10 years ago, and it was this month, 10 years ago, that we had the Great Eastern Earthquake and tsunami again in Japan. And I happened to be in our Tokyo office that day prepping for a 4:00 meeting that never happened, right? And I went back a month later for client visits and came away from that saying, oh my gosh, this is really going to change people's perspectives of supply chains. And I was surprised it did not have a big impact. But now I think the political environment is such that, the supply chain discussion is very relevant. We are going to see changes, but certainly welcome others' thoughts on that.
Just to kind of capture, and that's a nice segue in sort of the second pasture of discussion here, and that's, we go from fiscal and monetary policy down into the structures of the economy. So all three of you have leaned into this. And two have come out. Barb, you've mentioned the supply chain issue, this permanent change in sort of how we structure and manage supply chains that's linked to some of the new geopolitical shifts. happy to talk about that some more. I am most interested in the point you brought up, Eli, and that is the issue of opportunity. When we look at the data, this pandemic has aggravated all of the curse and negative effects of income inequality and wealth inequality in this country. And this is something I track for my teaching purposes and research purposes, but when you looked at even before the pandemic, our inequality was higher than it had been in the 1910s when we talked about the robber barons and this was a fundamental change in U.S. society that preceded the changes we saw with FDR to deal with the Great Depression. So typically with income inequality comes big social change. And we're seeing that. And fewer and fewer people buy into the system because they don't feel like it can serve them. And this is what raises political risk. So this is something we have to manage. And I need our audience to understand that income inequality has been increasing since the late 70s. This is not something that comes and goes with whoever is in the White House or in the Congress. But the pandemic really laid bare how unequal U.S. has become, how technology's aggravated that, but also how the inequality in access to healthcare manifests itself there in terms of life expectancy. So I would like to get each of your insights on this issue of inequality again, Eli, how is in a Fortune 100 company, how are you tackling this? How does this? I mean, where do you feel the impacts of this? I'm sure you feel it all over the business model. And then how do you move forward in trying to have what we call shared value creation? Right? You create profit for your shareholders, but you're also making sure that you reverse some of these very worrisome trends of increased inequality.
It's the quintessential, I don't know, put a number on $1 billion question, right? I mean, my point is it's on every leader's mind. I would anticipate, regardless of what sector you're in, because we all know, regardless of how robust a recovery is, regardless of how cheap debt is, regardless of how much access to capital there is, and companies are humming, the model is unsustainable if only certain sectors of a society economy continue to benefit, and that, to your point, is that gap goes wider and wider. And we've seen it across the world where people start to not believe in the system, and it creates social change. At least from my perspective, I think it's as an organization or as a leadership team or whatever, being very conscious of that and operating with that purpose of understanding the impacts your business, the ways you operate your practices, your operating model is having on the societies and countries and markets in which you operate, right? Because your consumers, depending on your sector, are reflective of that, and being very conscious about not only the practices you adopt, but also taking steps to make sure you have an impact to hopefully potentially be able to mitigate some of these or help drive the closing of that gap to the extent possible. I think you're seeing it play out in many different platforms, from calls from obviously certain levels of wage to companies actually taking a very focused and clear effort in terms of how they add to communities and societies in which they're employees, because the reality is also, depending on the business you're in, your employees span the entire strata of the economy and income levels, if you will, across this. And so those disparities a lot of times might not be as evident, but they're real, because if you're truly in touch with, again, not only your consumers, but your employees, it's something you have to address. So long way of saying, I think it's by being very purpose-driven and being cognizant of the fact that this is happening, and really through whatever means you have, trying to take steps to partner public, and it's a public and private, I think, ways of getting at this, to partner, and also to be very conscious of how we take deliberate steps to do your part to mitigate the impact of that, and also to help move the needle on closing it further. But I don't have an absolute answer for you. I think it's the recognition of it, and it's putting some deliberate steps to moving the needle on how you address it, provide access, continue to give people that opportunity, and also to move up, but also to help them lift out of it. So,
well, Eli, I think it comes back to the thing we were talking about. We're talking about a view of opportunity coming out of COVID, and that is mindset, executive mindset. That not only do we need a new executive mindset on how we look at opportunity and realizing that we have an opportunity to accelerate innovation more than we did before, but also that these issues of inequality are not separate from the organization. They're not arm's length. These sit in the boardroom. We have to address these questions.
Absolutely, Phil. And you know, I'll stop after this, but what you said, you know, from innovation even triggered a thought for me, right? You look at what's happened in fintech and how democratic or inclusive the solutions have becoming to providing payment solutions at the lower levels of the economic ladder. And really that's been disruptive, but that's created ecosystems and industries and an entire, you know, sort of innovation from, which has almost become mainstream, right? Really figuring out how they democratize payment systems, or, you know, and the move to digitization didn't leave, you know, the lower ends of the economy out. And I think, again, it can be nurtured and harnessed through the lens of innovation when you open the aperture of being inclusive.
Profit and the reversal of social ills can be mutually inclusive.
Absolutely.
Michael, what are your thoughts?
So I think that's right. I think we're arguing that stability in the political economy lens in part depends on a more equal sharing, not perfectly equal, but a more equal sharing. So I think what I think your point to opportunity and innovation here is important, because as economists we think of this through the labor share of income, which from the 50s to the 80s, labor got about 65% of all income. So 35% return to capital, about 65% return to labor. That fell, as you mentioned, multi-decade decline. It's at about 55% now. When economists look at what drove that, we think, you know, to the extent that we know these things, we think the number one driver of that was globalization, outsourcing. You know, the biggest declines in the labor share happened in manufacturing and trade. It's not, we don't think that there's a lot of support for the idea that it's technology making labor obsolete. So I think that's important, because Barb mentioned earlier, nationalism is one thing that is coming out of this, or I can't remember if it was you, Philip, or Barb, kind of coming out of 0809 and through the pandemic. I do think that there's been a shift in the political response, that there's been more nationalism. There's been a desire to protect supply chains, protect manufacturing, reshoring and onshoring. If there's a way to get a better balance there, a politically better balance, and the labor share can reverse a bit, we can be just as innovative and rely on technology and productivity gains, and I think not fear that we're going to replace labor, but also get kind of a better balance politically and economically. I would agree with you that one does not preclude the other, and that we can do both of these things at the same time, get stability in the macro economy as well as the political economy.
Barb, I want to hand it over to you. I want to add a question to kind of take us into the last pasture here. And by the way, I want to our audience. So we're going to have one more pasture of discussion here on the U.S. and the global economy. But pardon me. Please, if you have questions, we're going to have a short question and answer period moderated by Tim Smith. But please feel free to think about questions, and you can type them into the Q&A tab down at the bottom. Barb, love to get your take on the issue of equity and income inequality and the structural impacts on the economy. And then maybe also, I mean, Michael sort of leaned into this. Obviously, this has changed our economy is more unequal. It's changed the structure in that way. Also, our place in the world is different. And this is not only geopolitical, but trading relationships. So I'd love to get your take on the income inequality question, but then kind of take us into the next pasture discussion about what is the U.S. position in the world coming out of COVID, and what are some, if we're, as executives, as business decision makers, what are some new things we should be thinking about if we're engaged in international business? Barb.
Yeah, so life after COVID, and that has a nice ring to it. So I hope that comes quickly for us. The U.S. Does have an opportunity to lead, again, as we think about emerging economies who are oftentimes going to be struggling in this post-pandemic environment. So we'll see where that plays out, but that could be additive. And it's kind of fascinating, right? I've talked with many candidates who've interviewed with Principal over the years, and they've asked me about the reputation of the firm. And I said, it's striking. One of the most common things that I have people say to me outside of the US who are potential customers or existing customers is, you don't remind me of an American firm. Now, I take that as a badge of honor. And what does that mean? I think we listen rather than speak. And that's always good advice, right? We want to partner and be a trusted advisor. And as you think about that opportunity more holistically, it's big, right? And it can be impactful. But there are a lot of forces moving us against that. I mean, we've talked about the income equality and some of the political dynamics. One other that I'd throw out is interesting in that more and more businesses are not listing. They're avoiding the public listing and the scrutiny that comes from regulators and shareholders. And that's a really unusual dynamic that I think we need to all also be paying more attention to. Private equity is just booming. It doesn't matter where you are in the world. And that's a new dynamic, and it could either be positive for a lot of DE&I initiatives, or it could be a negative. And I'm not quite sure which way that goes right now. But I do think, the pressures on from shareholders, from public company boards, from regulators, Eli's nodding. It's excruciating out there in the world today, right? So trying to thread that needle and get the right balance is just tougher and tougher every day.
Well said. Well said. Eli, back question on U.S. markets as your team looks into 2021, 2022. Has there been any changes in the relative position of the U.S. market relative to other markets than before the pandemic? And is nationalism having an impact on the way that you look at your supply chains?
Yeah, I think it's a great question. It's not necessarily relative to the position as we think of things of the U.S. I think that obviously always is going to be front and center. As we look forward, I think two things, right? One is, the focus is always going to be on the long term, right? If you truly are, again, this is just my perspective as an executive. If you truly are as an executive that is focused on doing the right things for the business, creating shareholder value, really just being at the forehand of your business. You'll navigate the short term, but the focus is on the long term. And so really taking that lens and recognizing that, hey, look, in the short term, obviously there's a lot of pent up demand. You have to serve there are a lot of things, but more long term, how do you think of your business overall, your operating models are getting disrupted daily, your consumers and your supply chain. And candidly, the last 12 months, and specifically probably the last 2 to 3, have highlighted the low water mark of what everybody's supply chain is capable of delivering, right? Globally, right? You saw the port congestion, container issue, you could unpack it on so many levels, and what it highlighted, it created opportunity for some, it highlighted how inadequate others were. And so I think that's going to challenge any leader's perspective on not just through the lens of nationalism, but from a de-risking your supply chain perspective. Do you have opportunities to look at other geographies? I mean, some people are going to consider some aspect of onshoring. There's going to be a notion of actually how do you become more geographically dispersed across the globe, right? There are hubs emerging all over to better serve your customers through a speed and availability, and also just de-risking your overall supply chain perspective. Because two things: one, I talked about, hey, the recovery is a global recovery, right? And actually most firms today, regardless of what sector you're in, to a certain extent, your business, while it historically may have been US dominated, is shifting to a lot of the opportunity is also in international markets, right? So how do you serve those markets at scale and in an agile manner without being over-reliant on, models of the past that may have had, your supply chain or your production or whatever you do capacities and concentrated in certain geographies. So to answer your question, I think, yes, everybody's thinking of how do I de-risk my supply chain, not just from an availability perspective, but also through the lens of sustainability, through a lens of speed and innovation, and also through the lens of leveraging technology. But primarily, like I said, the last couple of months, what's happened have accelerated, I would anticipate, leadership teams that were contemplating that and put that more front and center, because again, trying to navigate what nobody had a playbook for was one of the most interesting, which culminated with the Suez Canal thing, right? Forget the port situation, right? And again, I'm giving real life examples so people can see what they see in the headlines. And so, I think there are those who are going to look at it through the lens of nationalism, but again, I try to rise above it and say, if you're playing for the long term and saying you're doing what's right for your company, consumers, and recognizing you play in a global marketplace, how do you develop long-term strategies that not only de-risk, but also help you optimize and capitalize on location, on obviously materials and labor, but also, just balancing the overall risk as well as your strategic opportunities through that lens. And so that's how, I think about it. And even going forward, some very mundane things, which I call ways of working, right, that should be top of mind for people. Look, the way we used to operate from a business perspective, if you're running a global team or a global marketplace, has probably changed, right? Business class travel might not come back. Actually, a lot of people are betting on the fact that it's going to be a different mix of how we do things, where it was a typical model, again, US-led or Western-led executives, even with your global teams, right? It's changing. You're going to see different ways of resourcing, of staffing. We talked about labor markets, what that means for how teams think about your mix of international, local talent, commuting patterns, and your work labor and your workforce's desire, and where people would make trade-offs and either be super commuters or work in different markets. Now they're challenging the paradigm of, hey, I could still be here. I was able to deliver at this level. And so I'm just peeling back the layers of the onion on the multiple, sort of strategic questions around your operating model, your labor force strategy, your supply chain footprint, that are going to come up, that are not going to be short-term solves if you're truly navigating for the long term. So I know I've said a lot, so I'll stop.
I love it, Eli. You're reminding us to get back to basics. Think strategically, right? Look at fundamentals and play for the long. It's the long play, right? It's not for the quarterly statements, for the 5-year plan. So well said. Again, it also emphasizes, I think, a theme that's coming through on this session, and that's mindset, right? If there's anything new about post-COVID, it's mindset, which is a little bit more subtle than, something that's right in front of us that we can touch. Michael, your thoughts on these questions, the global questions, and maybe the change in work, liberation from location that I think we can take advantage of or be cursed by.
Yeah, I think Eli's answer was great. So I cannot top that, but I will try and come at it from the point of view of Barclays, a UK bank, sitting in the middle of Brexit and having to deal with, you talk about mindset and strategic thinking, and I think Eli was discussing a business. So if the business model in the 70s and 80s was locating next to your end user, and that switched to a globalization platform, now we're kind of going a little bit back in the other direction, perhaps. Finance, at least our investment bank, is doing the exact same thing, right? Being a UK-based bank with Brexit, with a European regulator that now says, look, if you're going to clear and transact in a lot of these products, you got to do it on the continent. And we want your people to be here on the continent so we can monitor them, right? So compliance. And so nationalism has many different forms. It doesn't always have to be pejorative and political, as I think Eli was saying. We have to rise above that and think about what it all means for our business footprint. We've relocated billions of firm assets out of London and into our Barclays Bank Dublin. And we've relocated a lot of our people out of London into Dublin, Paris, Frankfurt, to be on the continent, for example. So we've had to do the exact same. I would say we were able to start earlier on it because of the post GFC regulatory environment change, and nationalism meant Brexit has been coming for, well, we got it like 5 years ago, but actually getting it in terms of a timeline was just this past December. So I'd say finance, at least where I sit, has been affected by this for some time. Perhaps now it's just hitting multinationals in a more critical way. But I would echo everything that Eli just said in terms of we've had to rethink our entire footprint. On a work from home basis, I suspect finance will be a mix, that it's an industry under margin pressure. We're an old industry. We're not a new growth industry, for example. So I think the C-suite people will be looking carefully at who can work from home, who does need to be in the office. Barclays has a big building in downtown Manhattan. Do we need all that space? People like me, and I think from an investment banking model, it's still very much apprenticeship, face-to-face. We probably need those people in the office. Traders, risk takers have to be in the office and be monitored. But then there's probably a whole bunch of the workforce at Barclays that could be more remote. So I completely agree with Eli that it may not be an entirely one or the other, but I think the mix shift will change. So I can only echo what he said and say that we're seeing it in my business line as well.
Well, I want to sort of end the formal kind of panel discussion with one last question for each of our panelists. So each of you, again, this question of, there's probably think about one thing that we haven't touched on that you feel like is important, whether it's, again, a lot in our audience, a lot of them are members of the Kelley School family, went to the Kelley School, love the Hoosiers, wish they were in the basketball tournament this year. We won't go into that. But but we have a lot of Kelley School, we have a lot of folks in business in our audience, and the three of you have had very accomplished careers. You've been at the heart of different parts of feeling the challenges and the opportunities of COVID-19. What would be one piece of advice, or perhaps one thing that you're seeing that, as our audience looks forward to 2021 and into 2022, they should hold on to? Or what's a piece of advice that you find yourself giving to folks, or thought you find yourself giving to folks when they ask you about where are we headed, either in your organization or just the world at large? Eli, go for it.
So first of all, I think it's a great question, and actually being on this panel with Mike and Barb has reminded me of it. And I've been fortunate enough in my career to have done a lot of work internationally. I was CFO in Australia, New Zealand for a division for several years, and had the opportunity to spend a lot of time there. And the reason why I say that is my advice to people would be, one, as leaders or as employees, whatever, we all have a responsibility, and I think a part to play, regardless of what sector you are in the global recovery, right, in terms of how we operate. But more specifically, my advice for people, particularly a lot of US-based people, is it's a global marketplace. Think through the lens of being a global leader, not just through the lens of, hey, my sandbox, my backyard. Because increasingly what I've seen, US trained or American-based professionals or leaders who have adopted and leaned into that global mindset are actually have a lot bigger impact and a lot more versatile, because a lot of times, again, our international counterparts bring both. So for me, it's, as a leader, your impact and what you do and how we navigate these times and uncertainty. And it's going to play out for the next couple of years, right? Look, this pandemic might be a blip from if handled well, but what we do know is some version of a variant or to Mike's point, this virus, or some new norm is going to come as a result of this. My encouragement for everybody, and piece of advice, will really lean into having a global perspective and a strategic global perspective as you navigate whatever you do, and don't get mired or caught down sometimes. And not just a nationalist, but we can be very myopic when it just comes to a US marketplace, US ways of doing things. And I think the pace of innovation, the pace of change, not even social, but business, is really going to be driven through the lens of, again, we talked a bit about globalization, but I think the reality is technology, the 24-hour news cycle, social media, however consumers consume things, has really made it a seamless and borderless. So you have to operate and think like that, for those of you who don't. And that would just be my encouragement. You heard Barb talk about it and her success, and the fact she talked about being a listening firm And again, having a lot of international experience there from her, and Michael as well being at a British, I think you see these American executives thriving because of that. So that, I'll get off now, but that would be my.
Great point. Again, Eli, it comes back to mindset. Barb, your thought or observation to what that you'd like to share as we kind of end the formal discussion here.
Yeah, I would probably categorize it as find your partners. And what do I mean by that? Surround yourself by people who are creative and innovative, yet at the same time practical. You need to not be constrained by old thinking, but instead be looking for new opportunities and new ways of disrupting yourself. And you'll find in corporate world, there are really great partners who can help you do that. And sometimes it's as important to get the right partners externally to aid you in your business planning as it is to find the right partners internally. So build your team.
Excellent. Right people on the bus in the right seats. That's more important than a lot of other things we do. It helps us sleep at night. We have the right people working around us. Michael, your thoughts?
So I concur with what Barb and Eli just said. I'll put it in a little bit of an academic setting in the following sense. I think what we need to succeed is in terms of CEOs, leaders, the C-suite. We're essentially, I think what we're arguing here is you need a combination of what would be the traditional liberal arts upbringing, strategic thinking, planning, asking the right questions, communicating, getting a plan, big thinking, be part of a global framework. Don't think you're just in a small backyard, partner with the right people. So, but at the same time, whether it's you or your firm, or you need to be proficient at something, right? You have to have a particular skill. You have to have an advantage. So just the way we kind of think that people need to be trained with a blend of kind of liberal arts critical thinking with some, outright technical experience in a particular field, we're essentially saying the firm has to be structured the same way. So you have to be better than what everybody else does at what you do. You have to do that. But I do think you need to overlay on top of that strategic and critical thinking that positions your firm for the medium term. If you're not doing one or both of those, you're likely to get eaten up along the way. So I think the way that we would combine kind of, everyone said, oh, you got to be a programmer, right? Well, now I think though it's more like, well, critical thinking skills and communication and getting a plan, building a team, having a plan, right, is important. You're not going to get buy-in from your people or your partners without a cogent plan and letting everybody know where you're going. So that's the way that I would answer that. You do kind of have to be all things, know yourself and know where you're going.
So as we move to the Q&A portion, and Tim comes online here, my biggest takeaway is the following. That is that, first of all, COVID is the loss of 500,000 Americans is just devastating and catastrophic. Can never lose sight for that. This will be an event that strikes this generation and will have an impact for a century. We're just now starting to see the impact. One of the impacts, though, is when you start to sit down and look at what's in front of us, there's much more positive opportunity than perhaps we ever realized. And I think that's a takeaway for our audience, and that is stop and just kind of pause and realize you can probably innovate faster. There's probably 2 or 3 times more opportunities than you thought. And when there's change, there's entrepreneurs can see the light of day, but you have to be sober about the environment. And now where we knew where the tripwires were, there's new tripwires, but we don't know where they are. So we got to be aware of the new risks. So with that, I don't see any Q&A in the I don't see any in the chat here. We're definitely going to have a hard stop at 1:30. If there's no questions, we'll stop. While we're waiting, maybe for anybody to ask some questions, I'm going to throw one more on here that I know everybody's interested on, and that is, where do we see equity markets? Where do you see equity markets heading in the next year? And I want to put forward a hypothesis. That is that you've got all this, people have saved their money. They haven't spent the money. There's this pent up demand. They couldn't spend it during the pandemic. We saw this huge influx in savings. And so people have this money to invest. And so they went out, maybe became day traders when they weren't day traders before. They're buying Bitcoin. They're maybe buying real estate when they didn't, or they're investing in dating trade cards. So my question is where do you see our equity markets heading? But how is this linked to the fact that as people start to, reverse that pent up demand and want to spend money on great shoes sold by great companies like Nike, are we going to start to actually see people have to pull their money out? Or we actually see a collapse in equity markets while we're seeing this economic rebound? So, Michael, what are your thoughts?
So hopefully I'm going to alleviate your fears. Actually, the data suggests I think most of the rise in excess saving is actually sitting in deposits. So I think to the extent that some of it is leaked out into equities or bonds or day trading, I think that is a very small percentage of the overall total. Excess saving, as I mentioned, may be up around 1.8 trillion. Deposits are up about 2 trillion over the same time period. It's almost exactly a one-to-one mapping. So I think what I would say that I wouldn't worry about that part of it. What I think, what our firm believes is we're not necessarily thinking equities are overvalued. It's just that equities are pricing in a lot of very good outcomes. So what we think will probably happen is earnings will be growing to kind of validate where pricing is. And although, as we discussed earlier, inflation is a risk, we don't think that it's a prominent one. And with central banks being very accommodative, it likely tilts the balance into favoring equities over bonds. So with the global policy backdrop putting downward pressure on official yields, we think the economic backdrop and the ability of a lot of this let's call it idle deposits to gradually flow back in, support earnings growth and validate those prices. We're pretty optimistic on equity markets. Now within that, there's obviously the US versus Europe, UK, timing of a lot of this, who's leading, who might be behinding, but I'm thinking in terms of a strategic asset allocation perspective, we still think favoring equities over bonds is the right course of strategy.
Well, we've got a couple of questions that came in, and Eli and Barb, certainly feel free to touch on these. This first question that I asked about the equities market. Here's another question. With more people working from home and businesses perhaps shrinking their physical footprint, how do you see residential and commercial real estate affecting the economy in the mid and long term? Barb, I'd love to get your sense from there from an investments perspective on the real estate market.
Yeah, so I'd start by going back to Michael's comments, which I completely concur with, but I'd also add that Tina is alive and well, and I'm not talking about Tina Turner. There is no alternative, right? You just can't get by buying bonds in a zero rate world. So I think that will continue to fuel the equity markets for the foreseeable future. But, there will be other implications, Phil, as you're noting, that will take a longer time period to work out. Residential is doing just fine. And obviously, with people living and working at home, for those who can afford housing, I'm stunned by the number of young staff people at our place who've moved houses this year, right? But I think when they're home and they have young kids at home, that's actually going to fuel a lot more growth on the residential side. And structurally, commercial, retail, it's just going to take longer. The bigger question I have in those markets is, will at some point, will the market correct enough to take care of it, or will we end up with some sort of a government program like we had in that 87, 93 time period of TARP? I'd hope the market finds a way through. We're already seeing a lot of malls getting converted again into housing and other more creative ideas. So hopefully the innovation takes care of what probably will be a glut in some of these commercial markets for a while.
Yeah, I would just echo that, and especially the piece you talked about around, the workforce and people moving or re-examining their choices, right? It's almost, we go back to economics and utility baskets, the utility of the cities they were living in or where they were shackled to, probably based on their employment. Now they're really examining that, and people have made choices. Now that's ultimately, there's an outflux from somewhere, but it's going to lead to obviously an uptick in residential. It depends on the market or geography. But I think that's something that every organization is wrestling with now. The corollary to that, or the flip side to Mike's point, is when things stabilize and a lot of companies ultimately land on what their workforce model is going to be, it's probably going to be a hybrid, right, of that. And so that I think is also going to either be a trigger or determined, because there might not be wholesale, hey, everybody. Tech has been obviously on the leading front of saying, hey, or a couple of tech firms, people could work from wherever. But you also look at their operating model and the product they make, it's very different, right? And to Michael's point around the workforce model and the nature of how you work. So I think it'll really be interesting, but for all intents and purposes, definitely the uptick in residential seems to be driven by a lot of people choosing to relocate or make different choices.
Eli, I'd love to follow up a question on that and introduce our last question topic, because we got to close out here by 1:30. Eli, I'm curious, internally to Nike, how are you handling this question of work at home versus not? Are there any significant changes? Are you actually divesting real estate? Second question is, the last question that has come through is China. Yeah. This question, that's kind of a one-word question. China? How's Nike? What's the perspective in the executive suite on sort of the rise of China versus US? I know there's different ways to go with that within your business model. And then Barb and Michael, we could go to you in terms of how you see that at a macro level.
So I'll play it this way, Phil, just because don't want any statements to be taken out of context. I always talk about it through my lens, just knowing
Sure.
The organization I work for. I think, look, when it comes to the workforce model on the back end of this, it's still TBD, right? I think, organizations have been flexible in the near term, but we're also, everybody's just trying to figure it out and understand, hey, how do you ultimately make the right decision for your workforce, while being cognizant of the business environment, but also, I think, understanding the needs of your workforce. So we're still in flux in trying to figure things out. I think when it comes to, sort of the international, China, pick any country. I think it's again, there's a bit of wait and see. There's a bit of not trying to be inflammatory, but I think there's also recognition that there are forces that are playing out on this at a political level that are much higher than any organization and its individuality. And so that's how I would answer it, right? I think, you're going to develop a balanced perspective, but also recognizing, hey, again, unless you're some bigger company, you're a cog in the wheel, and you just have to understand your risk profile, understand your opportunities, and understand how you'd like to navigate it. Some people want to jump in the fray, others recognize the importance of certain markets. And so that's, again, going back to my perspective on a strategic, holistic mindset. That's how I tend to approach it and thinking through it. But being very clear on understanding, you got to understand the chessboard, and there are certain things that are bigger than you, and how to navigate, stay above the waves. That's all I'll say.
That's great advice. Michael, your perspective on the question of the sort of China's ascendance, its economic maturation, and what that means for us.
I think Eli's right in the sense time is going to tell on this one, and it's going to play out over many years, right? I think that I think our interpretation of the Biden administration's approach will mean, yes, some sectors will be affected more than others. I don't think that they will be relying on tariffs, for example, but I think they will take a hard look at drug supply chains, pharmaceutical and biotech supply chains. Are they, do we have enough redundancies in NAFTA, the NAFTA region, for example? And I think the focus will be in a lot of, say, 5G technologies, right? So it's not containment in the 80s US-Russia sense, right? Where we have two separate spheres, right? I think we used to trade with Russia about $2 billion a year. We probably do that in about 10 minutes with China, right? So nobody's talking about decoupling and going back to containment, but we are kind of talking about, let's say, co-managing a rise. And are there parts of the economies that we just don't want is linked? Because from a national security perspective, we're not aligned with them entirely. So I think it's going to be a different model. And I think it's going to affect some sectors much more than others. I don't think we're going to see really any of that in 2021. I think to do that effectively, the administration would have to line up allies and co-sponsors on this. The US can't enact that effectively alone. It may take 12 to 24 months to build out a blueprint, talk to allies before you even start thinking about policies. So that would be kind of my response is I would say, think about more of it managing a rise of both economies rather than, taking something and slicing them apart. And I would look for its largest effects in technology, biotech, and pharmaceuticals.
That's a balanced, practical way to frame it. I like that. Barb, your last thoughts on China, and then I think we're hitting our time here.
Yeah. So we've been in China since the 90s. We actually have one of the longest asset management joint ventures with China Construction Bank. So it's a very important market for us. And again, kind of despite what's going on politically, it all comes down to being able to deliver value within that joint venture. Right. So I think that's just something that we all need to learn how to do, regardless of, which party's in power, where the political winds might be blowing. If you're committed to a market, if you're committed to partners and customers, they should know that you're committed. And that's playing the long game. Right. And you have to do that in these key strategic markets. You cannot be tactical in your approach.
Well said again, back to mindset. So for those in our audience, for our Kelley alums out there, as you come away from this session, it's about your mindset. There's more opportunity than you think is out there. Don't be distracted by tactical. You have to make tactical decisions, but think strategically. And there's a lot. We could be on the cusp of a new golden age. So anyway, we've hit the bottom of the hour here. Thank you, Eli. Thank you, Michael. Thank you, Barb, for your time. I want to thank the Institute for International Business, who I love working with. And it's great to be a Hoosier. I mentioned that our men's team hadn't made the tournament. If you've been following closely, our women's team did make the Sweet 16, so we are very proud of them. So anyway. We miss you here in Bloomington. Hope your spring is well. And thank you for attending. And God bless the Hoosiers. Tim.
Thanks so much, Phil. And thank you to all of you for sharing your expertise, your thoughts, and your optimism with us today. And thank you for your substantial contributions to this important and ongoing discussion. So with that, I'll wrap us up. Thank you all again. We appreciate your time, and thank you all for participating in our ongoing Global Roundtable Discussion Series.
Thanks, Tim.
Thanks, everyone. Take care. Be well.